right now, out on the internet, there is this entire economy operating, completely in the background.
Yeah, totally invisible to most of us.
Exactly. I mean, we're talking about software programs autonomously hiring other software programs. They're buying computing power and settling these tiny micro debts for literally a millionth of a penny per millisecond.
It's wild to even think about.
It is.
Yeah.
And here's the kicker, right? About 99.8% of that invisible hyperspeed economy is running on a single digital currency, a currency minted by one publicly traded company.
Right.
So welcome to this deep dive, everyone. Our mission today is to break down the Q1 2026 earnings call for Circle Internet Group, Inc. That's ticker symbol CRCL.
And we are skipping the corporate fluff today.
Oh, absolutely. We're going to give you the data forward, actionable intel you need, because we are looking at the exact quarter where the underlying narrative of digital money fundamentally fractured from the rest of the crypto market.
It really is a critical inflection point. I mean, if you are analyzing this company through the lens of, say, Bitcoin volatility.
Right, like standard speculative token trading.
Yeah, exactly. If you do that, you are essentially trying to value a modern data center using the metrics of a 19th century railroad. Just the underlying mechanics of the business have completely shifted.
I want to start exactly there, actually. With our Talk Tickers framework, we are going to hit the headline numbers, unpack the story behind them, look at management's guidance, and give you our bottom line. Is this a bullish or bearish signal?
I love it. Let's get into the numbers.
Okay, because reading through this earnings report, the raw data suggests a company operating in an entirely different reality from the broader digital asset space. Let's look at the top line first. Total revenue and reserve income hit $694 million.
Which is massive.
Right. It's a 20% increase year over year. And revenue less distribution, transaction, and other costs, that grew 24% to $287 million.
Yeah, solid top line growth.
But top line revenue is just the hook, Yeah. What really stood out to me and made me literally stop reading and reread the line was the adjusted EBITDA.
Oh, yeah. The EBITDA is the real story here.
It reached $151 million, also up 24% year over year. But they generated an adjusted EBITDA margin of 53%.
Yeah, that 53% figure is, without a doubt, the single most important metric in the first 10 pages of the earnings release.
Right, because if you look at a traditional financial services company or even like a legacy payment processor, they are usually fighting tooth and nail for margins in the, 20 to 30% range?
If they're lucky.
Exactly. Traditional banks are weighed down by physical branches, massive human compliance departments, legacy server architecture. A 53% margin looks like an enterprise SaaS company in a raging bull market, not a global payments layer.
Well, it proves out the thesis of software-powered money, doesn't it?
Unpack that a bit for the listener.
So when Circle scales its operations, it doesn't need to build a new physical branch in Frankfurt, right?
Right. No brick and mortar.
Or hire 1,000 tellers in Tokyo. The underlying infrastructure, the blockchains that their stablecoin actually operates on, that scales globally almost instantly.
So it's basically pure software leverage.
Exactly. So when revenue increases 20%, their operational expenditure doesn't increase at a 1-to-1 ratio. I mean, the marginal cost of processing an additional $1 billion in transaction volume is essentially zero.
Just server compute, basically.
Yeah, basically nothing. And that's how you achieve, and more importantly, maintain a 53% EBITDA margin in this space.
That is just wild. Let's apply that to their core asset, USDC. The supply of USDC in circulation ended the quarter at $77 billion.
Which is a solid number on its own.
Right. It represents a 28% year-over-year growth. But honestly, I think focusing on the $77 billion supply is kind of a trap for investors.
How so?
Well, the supply is just the gas in the tank, right? The actual metric that matters is how fast the engine is running. And the on-chain transaction volume for USDC exploded by over 260% to $21.5 trillion in just one quarter.
Yeah, trillion, with a T.
$21.5 trillion in a 90-day window. I mean, to put that in perspective, they cited Visa's commercial transaction volume data. And based on that, USDC now accounts for roughly 63% of all stablecoin transactions globally.
It's a staggering market share.
And if you include other third-party networks, like Solana, for example, Circle is claiming 80% of all on-chain dollar digital currency transactions.
This is exactly where we have to distinguish between monetary supply and monetary velocity.
Right. Explain velocity here because it's so critical.
So you have $77 billion in static supply, generating $21.5 trillion in quarterly volume.
Mm-hmm.
Think of it this way. If you print $1 billion in physical paper cash, right?
Go on, Muki.
You stick it in a bank vault. You have $1 billion in supply, but it has zero economic utility. It generates literally no activity.
Right, it's just gathering dust.
Yeah, exactly. But if you have a single physical dollar bill and it changes hands 50 times a day, like buying a coffee, tipping a barista, buying a newspaper.
That single dollar generates $50 of economic volume.
Yes. So what we're seeing is that USDC is no longer just sitting in digital vaults waiting to be traded.
It's changing hands constantly.
It is actively being utilized as the plumbing for real economic activity. I mean, that 260% increase in volume, despite the supply only growing 28%, that tells us the velocity of this money is increasing exponentially.
Which brings me to a massive discrepancy that I frankly really struggled with while reviewing the broader market context for this quarter.
Oh, I think I know where you're going with this.
Yeah. If you were watching the digital asset markets between October 2025 and the end of Q1 2026, you saw a bloodbath.
It was brutal.
Broad crypto markets declined roughly 45% from their peak. Bitcoin, Ethereum, the major altcoins, they all just tanked. And historically, stablecoins are essentially the poker chips of the crypto casino.
That's the perfect analogy.
Right. When the casino empties out, the poker chips get cashed in. But during this 45% market crash, USDC circulation stayed flat sequentially, and it even grew 28% year over year.
So why didn't Circle's revenue and supply crack alongside the broader crypto market?
Because the poker chip analogy is officially dead.
Wait, really? Dead. Completely dead for Circle. What you are identifying in these numbers is the great decoupling.
Okay, I understand the theory of a decoupling, but historically, if retail trading volume drops, stablecoin demand drops. Because you use the stablecoin to trade the volatile assets, are you saying they've entirely replaced that retail trading volume with something else?
Yes, exactly that. I mean, for years, the primary use case for USDC and stablecoins broadly was as a safe harbor or a trading pair.
Right. You sell your Bitcoin, you park the value in USDC.
Yeah, or you want to buy a new speculative token, so you use USDC. And if speculation dried up, stablecoin volume dried up. But what the Q1 data proves is a structural break from that historical correlation.
So they actually pivoted.
They did.
Yeah.
Circle has actively and successfully transitioned its business model. They are shifting the majority of their volume away from speculative retail trading and toward durable, non-speculative business-to-business global utility.
Okay, let's pull on that thread, because the story behind these volume numbers relies heavily on enterprise adoption. In the earnings transcript, management spent a huge amount of time highlighting real-world B2B utility.
They really hammered that point home.
They did. They are actively trying to signal to Wall Street that this $21.5 trillion isn't coming from day traders in their basements anymore. This is about massive multinational corporations managing their treasuries and paying their bills.
And, the specific corporate names they brought to the table on this call, they are not fringe Web3 startups. They are foundational pillars of the modern digital and physical economy.
Yeah, the first one that caught my eye was Meta. They announced that Meta is now using USDC for creator payouts. And strategically, this is just fascinating to me.
It's a huge win.
Because if we rewind just a few years, the prevailing terror in the stablecoin industry was that big tech companies would simply build their own walled gardens.
Right, the whole proprietary token fear.
Exactly. Meta had the Diem project. Apple has Apple Pay. I mean, why would a company with billions of captive users adopt a third-party token like USDC when they could just invent, metabucks and capture all the value for themselves?
That was the existential threat to Circle for half a decade, frankly. And the logic was sound. If you control the social network, you can force your users into your proprietary currency.
So why didn't they? Meta's integration of USDC proves that the walled garden approach to global digital money is basically a failure, right?
It really is.
Why did it fail, though? Is it just regulatory pushback, or is there a mechanical reason Meta surrendered and went with Circle?
It is a combination of massive regulatory friction and, honestly, the overwhelming power of network effects.
Make that real for me.
So a digital currency is only as valuable as its interoperability. If you earn your metabucks for creating a viral video, but you can only spend them inside Facebook, they aren't very useful.
Right. You want to be able to pay your rent or buy groceries or invest that money.
Exactly. You want an open standard. And Circle has spent years doing the incredibly tedious, unglamorous work of building out that plumbing.
The boring infrastructure stuff.
Yeah. They got USDC listed on dozens of blockchains, integrated into hundreds of global crypto exchanges, and recognized by regulators across multiple jurisdictions. If Meta wanted their proprietary coin to be truly useful, they would have to replicate all of that global plumbing entirely from scratch.
Oh, wow. It's the equivalent of a tech company trying to invent a proprietary charging port today.
USB-C 1.
Right, and USDC is the USB-C of digital money.
That is exactly it. Meta choosing it is a massive concession that Circle's network effects constitute an impenetrable moat. They are the neutral default standard now.
And it's not just tech platforms doing creator payouts either. They highlighted DoorDash using USDC to pay drivers globally.
Which solves a huge remittance headache for a company like that.
Totally. But the real heavy lifting, like the stuff that actually drives that $21.5 trillion in volume, comes down to B2B treasury management.
Yes. The corporate treasury flows are the golden goose here.
They announced integrations with platforms like Kyriba and Ramp. Now, if you aren't a corporate CFO listening to this, Kyriba might not mean much to you, but they are a massive treasury management system used by Fortune 100 companies.
They are deeply entrenched in legacy finance.
And Ramp is one of the fastest growing fintechs in the corporate expense base. So to understand why Kyriba and Ramp integrating USDC is so significant, you have to look at how broken traditional corporate treasury flows are today.
Oh, it's a nightmare. Imagine you are a Fortune 100 company based in the US, right?
Right.
And you need to pay a major supplier in Singapore, fund your payroll in Europe, and balance your ledgers in Brazil.
I imagine you just use Swift, right? You wire the money.
You use Swift, yeah. But Swift is a messaging system. It is not an actual settlement system.
Wait, what's the difference?
So your bank sends a message to a correspondent bank, which takes a fee, and then sends a message to another bank, which takes another fee. And maybe, 3 days later, the money actually settles in the target account.
And during those 3 days, that capital is just locked up.
Exactly. It's not earning interest. It's subject to currency fluctuation risk. It is a highly, highly inefficient use of capital.
So by integrating USDC into Kyriba, a corporate CFO can essentially bypass that entire correspondent banking network.
That's the pitch. They log into their standard, familiar treasury dashboard on Kyriba. They hit send to route, say, $50 million to their Singapore subsidiary.
And it just goes.
The API converts the fiat to USDC, sends it over a blockchain in literally 3 seconds for a fraction of a penny. And the Singapore branch instantly off-ramps it into local currency. The capital is freed up immediately.
That is incredible. And that is how you generate $21.5 trillion in volume. It's not 1 million people trading $10 on an exchange. It's 1,000 massive corporations moving billions of dollars dynamically, 247.
Exactly, it's utility.
Even Y Combinator, the premier startup accelerator, they are now driving funding operations in USDC. So the next generation of tech unicorns are being capitalized natively on this infrastructure.
Yeah, from day one.
But this raises a major mechanical question for me. How is Circle actually getting crusty traditional banks to adopt this? Because if you walk into a 100-year-old legacy bank and tell the compliance officer, hey, we are going to route your cross-border payments over a public blockchain, that compliance officer is going to have an absolute panic attack.
Oh, they absolutely did have panic attacks.
Yeah.
For a long time, the friction of blockchain adoption at the institutional level was just insurmountable.
Because of the risk.
Yeah. Traditional banks recognize the speed and cost benefits of USDC, but they absolutely refuse to deal with the operational nightmare of actually implementing it.
What exactly is the operational nightmare for them?
Well, first, custody. If a bank holds $1 billion in USDC, they have to physically secure the cryptographic private keys. If a rogue employee walks out with a thumb drive containing the key,
And money is just gone forever.
gone. And traditional banks just don't have the technical expertise to manage cryptographic key sharding or multi-party computation.
Right.
Second is compliance. Monitoring a public blockchain for anti-money laundering regulations requires entirely new software suites and investigative protocols.
Yeah.
The banks looked at all this and essentially said, it's too far outside our core competency. We'll just stick to Swift.
So Circle realized they couldn't just sell the stablecoin, right? They had to sell the entire IT department alongside it. And that brings us to the Circle Payment Network, or CPN, and specifically their new product, CPN Managed Payments.
This was, without a doubt, the strategic masterstroke of the quarter.
I was looking at this managed payments product, and my immediate thought was that Circle is essentially building the Amazon Web Services, the AWS of money.
Oh, that's a great way to frame it.
Think about it. If you look back to the early 2000s, if you wanted to launch a software startup, you had to physically buy servers, you had to rent a server closet, install heavy-duty air conditioning, and hire IT staff to maintain the hardware. It was a massive upfront capital expense. Then AWS comes along and says, don't build a server farm, just rent virtual space on ours. We will handle the hardware, the cooling, the security updates. You just write your code.
Circle's doing the exact same thing for blockchain compliance, right?
That is a perfect structural analogy. CPN Managed Payments is a fully turnkey service. Circle goes to these legacy banks and says, look, don't build your own secure crypto custody solutions. Don't hire 50 blockchain forensics experts for AML compliance. Don't worry about managing the liquidity between different network layers.
Just plug in our API.
Exactly. Just plug our API into your existing interface. We will act as the managed service provider handling all the underlying complexity.
And the adoption numbers bear out how effective this pitch is. In Q1, they had 136 financial institutions enrolled in the Circle payment network. That is up 36% quarter over quarter. They hit $8.3 billion in annualized total payment volume in Q1, and they specifically noted on the call that they were approaching $10 billion by early May.
And what investors really need to understand about CPN Managed Payments is the stickiness of the product. Yeah, talk about that.
This isn't a consumer app you delete when you get bored. When a traditional bank rips out its legacy cross-border settlement process and replaces it with a managed API that saves them millions in operational costs, they are locked in.
Because the switching costs are too high.
The switching costs to revert to Swift or to migrate to a competitor's managed service are prohibitively high. Circle isn't just selling a token anymore. They are embedding themselves permanently into the back-end ledger systems of global finance.
So we have human corporations, Fortune 100s, and legacy banks adopting this infrastructure to cut costs and increase speed. That is a really solid, understandable enterprise narrative.
Right, standard B2B logistics.
But management didn't stop there. CEO Jeremy Allaire pivoted the earnings call from that standard B2B stuff into what feels, on the surface, like absolute science fiction.
Yes, the AI narrative.
I want to transition to this agentic economy narrative.
Yeah.
Because if human corporations are moving to USDC, what happens when the entities moving the money aren't human?
It's the collision of AI operating systems and economic operating systems. This was Allaire's primary thesis. And you're right, it requires a pretty significant mental leap for a traditional financial analyst.
Let's try to ground this in reality for a second, because AI agents has become such a buzzword. When Circle talks about an AI agent, they aren't talking about a chatbot where I type in a prompt and it writes a polite email for me, right?
No, not at all.
Yeah.
A chatbot is reactive. It waits for human input, generates text, and then it stops. An AI agent is autonomous and goal-oriented.
Okay.
You give the agent an objective, and it goes out into the digital environment, interacts with other software applications, makes decisions based on real-time data, and executes multi-step workflows without you holding its hand.
Let's map out a real-world scenario so we can visualize this.
Yep.
Let's say I run a logistics company. I deploy an AI agent, and I say, optimize our shipping routes for the next 24 hours based on real-time weather data and fuel prices.
Okay, perfect example. So the AI agent starts working. It realizes it needs access to a premium satellite weather data API, which costs money. It realizes it needs to rent extra cloud computing power from Amazon Web Services for the next 3 hours to run the routing simulations, which also costs money.
Right.
It needs to purchase real-time commodities data for diesel prices, which costs money.
And here's the bottleneck. The AI agent cannot pull a physical corporate credit card out of a wallet.
Exactly.
It cannot walk into a Chase branch, show a driver's license, pass a KYC check, and open a business checking account. It has no physical identity. It is just a block of code. So how does it actually pay the weather satellite API?
This is the fundamental problem Circle is solving right now. Autonomous software requires internet-native, programmable money that can be manipulated purely via API.
Because traditional banking just doesn't work for them.
Traditional banking infrastructure is built around human identity and physical settlement. The Circle agent stack they announced is built specifically to give machines the ability to transact.
Let's break down the products they actually launched in this agent stack. The first one is agent wallets. This allows AI to permissionlessly build on-chain wallets and transact within predefined safety guardrails. So the AI literally has its own digital bank account.
Yes. You, as the human operator, can fund the agent wallet with, say, $100 in USDC. and you code a smart contract guardrail that says you can spend this money, but no more than $5 per transaction, and only with approved enterprise API endpoints.
So the agent now has autonomous purchasing power, but within limits.
Exactly.
Now, the second product is the one that really demands a technical explanation from you. Agent nano payments. They claim this enables transactions as small as 1/1,000,000th of a penny.
Yeah, that number sounds impossible.
It really does, because I have to push back here. If I try to use my Visa card to buy something for a single penny, the merchant loses money because the fixed network fee is like 30 cents.
Right, the economics don't work.
And even on a public blockchain like Ethereum, gas fees can be $1 or more. How on earth do you settle a transaction for 1/1,000,000th of a penny without the transaction fee just obliterating the principal amount?
It's a crucial question because you cannot execute nano payments on a traditional public blockchain mainnet. The compute cost is just too high. Circle achieves this through high-frequency, off-chain state channels or highly specialized Layer 2 scaling solutions.
Walk me through a state channel mechanic. How does that actually work?
Think of a state channel like opening a digital bar tab. The AI agent and the cloud server it's renting establish a direct peer-to-peer cryptographic connection off the main blockchain.
Okay, so they're communicating privately.
Right, and the AI agent streams payments. Literally 1/1,000,000th of a penny for every microsecond of compute power it consumes directly to the server. These transactions are tracked locally between the two parties at the speed of light.
So there are no gas fees.
There are no gas fees for these micro-updates because they aren't being broadcast to the global network.
So they are just updating an IOU back and forth between themselves.
Exactly. And when the AI agent is finished with the server 3 hours later, they take the final tally of that bar tab, say $2.45 in total, and they settle that single final transaction on the public blockchain.
Oh, wow. So you bypass the friction of the network while retaining the security of the blockchain for the final settlement.
You got it.
This completely breaks the traditional subscription model. I don't have to pay a $50 monthly fee to AWS just in case my AI needs server space. My AI just streams microcents exactly proportional to the compute it consumes in real time.
It enables a high-frequency, machine-to-machine commerce model that is physically impossible in traditional fiat systems.
To aggregate all this, Circle also launched the Agent Marketplace, which they described as a hub with over 500 endpoints for AI agents to discover and pay for programmatic services.
It's essentially an app store where robots go to hire other robots.
Which is equal parts amazing and terrifying. But this brings us to the most staggering statistic of the call, and one I immediately viewed with a lot of skepticism. They stated that on AI agent protocols, specifically referencing the X402 standard USDC, is being used to settle 99.8% of all transactions.
99.8%. It's total dominance.
Here is my friction point, though. When I hear a 99.8% market share, I hear monopoly. But we are talking about an AI agent economy that, in the grand scheme of global finance, is essentially a newborn baby.
Sure.
Isn't a 99.8% monopoly of a market that barely exists yet just a rounding error? If 99.8% of the transactions equal $100, who cares? Aren't we getting ahead of ourselves, pricing this in as a massive win for the stock?
Well, you're correct that the gross volume of machine-to-machine payments today is just a fraction of human corporate treasury volume. However, valuing a technology company requires looking at the derivative of growth.
Okay, explain that.
The absolute dollar amount today matters far less than the entrenchment in the foundational layer of a rapidly scaling technology.
So unpack the entrenchment for me. Why does today's monopoly guarantee tomorrow's dominance?
Because software development relies heavily on standardized libraries and protocols. If you are a developer building a new AI agent today and you need to integrate a payment module, you are going to look at the X402 standard, see that literally every other service on the network accepts USDC via the Circle agent stack.
And you just adopt it by default.
Exactly. You will adopt it by default. The switching costs and the friction of trying to introduce a competing stablecoin or, God forbid, a fiat API into a machine economy that is already standardized on USDC are astronomical.
So they're building the protocol level.
Circle is positioning itself as the TCP/IP of machine money. They are minting the native currency of the AI economy before the traditional banks even realize the AI economy needs a currency.
That is a phenomenal way to look at it. And
Yeah.
Circle isn't just selling this AI narrative to Wall Street. They are aggressively dogfooding it internally. Management stated on the call that 85% of Circle employees are now weekly active users of internal AI coding tools.
They are walking the walk.
They really are. And they have deployed over 600 AI native apps internally this year alone.
Which, by the way, loops us perfectly back to our analysis of that 53% adjusted EBITDA margin from the beginning of the show.
Oh, right. Because if 85% of your workforce is augmented by AI, your revenue per employee skyrockets.
Exactly.
You are using agentic workflows to write code, test software, manage internal ledgers, and automate compliance checks. You accelerate product velocity without linearly increasing engineering headcount.
They are proving the efficacy of their own thesis directly on their own balance sheet.
It's brilliant. So we have the B2B flows moving on to USDC for efficiency, and the entire nascent AI economy running on it for lack of alternatives. But looking at the broader ecosystem expansion detailed in this call, Circle is clearly transitioning away from being a single asset company. They are expanding the portfolio.
Yeah, they recognize that a true global economic operating system requires more than just a US dollar proxy.
They detailed the growth of EURC, their euro stablecoin, which doubled year over year to 358 million euros. They highlighted USYC, which is the world's largest tokenized money market fund, now sitting at over $3 billion in assets.
Huge numbers.
And they even teased the launch of Seer ETC, which is a fully compliant, secure, wrapped version of Bitcoin. But frankly, all of these assets just feel like passengers on a train to me. What I really want to dissect is the train tracks they are building. Let's address the massive multi-million-dollar elephant in the room, the upcoming launch of the ARK network.
The crown jewel of their forward-looking strategy.
Okay, so I looked at this announcement, and from a pure capital allocation standpoint, it raised massive red flags for me.
Really? Why?
Because Circle already has USDC running natively on 34 different blockchains: Ethereum, Solana, Avalanche, Base, you name it, they are there. Why is a company that is finally achieving mature 53% margins suddenly spending hundreds of millions of dollars to build its own proprietary Layer 1 blockchain?
I see what you mean.
Isn't that violently redundant? Why build the 35th blockchain?
Because the current state of having 34 different blockchains is a fragmented nightmare for the exact institutional client Circle is trying to court.
Explain the fragmentation problem mechanically. If I'm a CFO, why do I care if the token is on Ethereum or Solana?
Okay, imagine those 34 blockchains as 34 sovereign island nations. They all have different native languages, different coding languages like Solidity or Rust. They have different security models and different consensus mechanisms.
Right.
So if you are a corporate treasurer and you have $50 million in USDC sitting on Ethereum, but the AI compute service you need to pay only accepts USDC on Solana, you have to move the money across the ocean.
And to do that, you have to use a cross-chain bridge.
Precisely. And cross-chain bridges are historically the weakest, most dangerous infrastructure in all of crypto. They are massive honeypot.
Because they just lock the funds up, right?
Exactly. A bridge essentially locks your Ethereum USDC in a smart contract and mints a proxy token on Solana. If there is a single bug in the bridge's code, North Korean hackers drain the smart contract on Ethereum, and your Solana proxy tokens instantly go to zero.
Wow. Yeah, no Fortune 100 CFO is going to risk corporate treasury funds on a decentralized bridge governed by anonymous developers on Discord.
Never. So Circle realized that to win the institutional market, they had to solve the bridging problem natively themselves. They built the cross-chain transfer protocol, or CCTP.
I saw that in the report. CCTP is a massive innovation, right? Because it eliminates the honeypot.
It does. It uses a mint and burn mechanism instead of locking funds.
Right. If you want to move $50 million from Ethereum to Solana, CCTP explicitly destroys the $50 million on Ethereum, completely removing it from existence, and natively mints $50 million of fresh, official USDC directly on Solana. There is no pool of locked funds to hack.
And the volume validates that approach. CCTP reached almost $50 billion in volume in Q1 and holds 60% of all cross-chain traffic right now.
So they have the highway system figured out, but that still doesn't explain why they need to build their own destination, the ARK Layer 1.
Well, because even with secure transfer protocols, public networks like Ethereum or Solana are noisy.
Noisy how?
They are filled with retail meme coin speculation, unpredictable gas fee spikes, and a complete lack of inherent privacy controls. Traditional financial institutions, like the BlackRocks of the world and hyperfast AI agent networks, require a purpose-built environment. Jeremy Allaire calls it an economic OS.
An economic operating system. So how does ARK technically differ from a standard Layer 1?
ARK is built with institutional compliance, programmable privacy, and enterprise-grade throughput baked directly into the base layer code. But the real magic is how it integrates with CCTP.
Because they own both.
Yes. Because Circle controls the ARK network, CCTP is hard-coded into its DNA. This means if a bank issues a tokenized real estate fund on the ARK network, that asset has instant, seamless, completely secure access to liquidity across all 34 other chains.
Oh, that makes sense.
ARK is designed to be the ultimate interoperable liquidity hub. You do your complex financial engineering in the safe, compliant environment of ARK, and then seamlessly route the capital wherever it needs to go globally.
And Wall Street is buying that thesis aggressively. Let's look at the financial mechanics of the ARK token presale, because this is where the TradFi money really entered the chat. Circle raised $222 million in a presale for the native ARK token.
That's a huge raise.
And they did it at a massive $3 billion fully diluted valuation, or FDV.
Yeah, $3 billion FDV for a network that hasn't even hit mainnet launch is a very powerful signal.
Let's clarify FDV mechanically for the audience real quick. When they say a $3 billion fully diluted valuation, they don't mean they actually raised $3 billion in cash.
No, definitely not.
They mean if you take the price of the single token sold in the presale and multiply it by the absolute maximum number of tokens that will ever exist in the future, the total network value is $3 billion.
Correct. It is a projection of the total market capitalization once all the supply is eventually unlocked.
What really fascinates me is the cap table of this presale. It's not just the usual Web3 venture capitalists. Yes, A16's crypto led the round, which is expected. But look at the traditional finance titans participating. Apollo Funds, BlackRock, Janus Henderson, the Intercontinental Exchange, Standard Chartered.
The gatekeepers of global capital.
Exactly. When BlackRock and Apollo invest in the infrastructure layer, they aren't just taking a speculative venture bet. They are funding the exact plumbing they intend to use to tokenize their own assets in the future.
They are securing early governance and network equity in the operating system they plan to deploy their funds on.
That brings us to the tokenomics, because how this ARK token is distributed creates a very specific, self-reinforcing flywheel that directly impacts Circle's core business.
The tokenomics are fascinating here.
According to the white paper, Circle retains 25% of the total ARK token supply. That is their founder's allocation.
The equity for the architect, essentially.
But 60% of the tokens are reserved for ecosystem grants, airdrops, and developer incentives. Now, to a traditional stock investor, giving away 60% of your product sounds like terrible business. Walk me through the mechanical flywheel of how handing out free tokens makes Circle a more profitable company.
It is the standard Web3 bootstrapping mechanism, but applied to institutional finance. A blockchain is useless without applications. Trading platforms, lending protocols, AI marketplaces.
Right.
So Circle uses that 60% reserve to aggressively pay top-tier developers in ARK tokens to build on their network.
They are subsidizing the application layer to kickstart it.
Yes. Because those applications are highly incentivized and well-funded, they attract users and institutional capital to the ARK network. Now, when that capital arrives on ARK, what currency are they using to transact within these applications?
Well, they use USDC. It's the native stablecoin.
Exactly. So the utility and total circulating volume of USDC explodes. And as USDC supply grows to meet this new demand, Circle's core revenue, which is the interest they earn on the underlying U.S. Treasury bills backing the stablecoin, that revenue grows exponentially.
Ah, I see.
Furthermore, as the ARK network becomes the dominant institutional blockchain, the intrinsic value of the ARK token appreciates. And remember, Circle is holding 25% of the total supply on their balance sheet.
The incentives are perfectly aligned here. They give away the network tokens to drive adoption, which drives stablecoin usage, which generates real dollar yield for them, while simultaneously inflating the value of their 25% token stash.
The success of the decentralized network directly feeds the centralized company's bottom line.
This brings us perfectly to the analysis of management guidance, because the financial mechanics of that ARK token launch are going to do very strange and, frankly, very profitable things to Circle's income statement.
This was the most nuanced part of the Q&A session with the Wall Street analysts. It requires us to get into the weeds of accounting principles.
Management explicitly stated they are leaving full year 2026 financial guidance unchanged. Now, if you are a retail investor scanning the headlines, you see guidance unchanged, and you think, okay, the business is static.
Which is a mistake.
Because reading the transcript, there's a massive multi-billion-dollar asterisk attached to that statement.
It is a masterclass in structurally conservative guidance.
I was tracking CFO Jeremy Guine's comments on how the ARK token impacts the balance sheet. He laid out an accounting mechanic that is going to unleash a tidal wave of pure profit. Let's walk through a literal hypothetical ledger example of this cost basis zero accounting trick.
Gladly. Let's set up the balance sheet. When Circle's developers write the code to launch the ARK network and generate the native tokens, accounting rules dictate how those tokens are valued internally.
Right.
Because Circle didn't purchase these tokens on an open market, they just minted them out of thin air via code. They sit on Circle's balance sheet at a cost basis of 0. The asset costs nothing to produce.
Okay, so the cost of goods sold is mathematically 0.
Correct.
Yeah.
Now, Circle ran a presale and raised $222 million. They have an obligation to deliver those ARK tokens to Apollo and BlackRock when the network launches.
So what happens then?
When the network goes live and those tokens are delivered, how does Circle recognize the value? Because the cost basis is 0, the revenue recognized from delivering those tokens drops directly into the other revenue line on the income statement.
Wait, if the revenue has 0 associated cost of goods sold, it doesn't get chewed up by gross margin calculations.
It flows almost 100% straight down to the bottom line. It drops directly into adjusted EBITDA.
That is wild.
And it doesn't stop at the presale. Remember the 60% reserve for developer grants?
Yeah.
When Circle issues an incentive grant to a developer, they recognize the market value of that token in other revenue and record a corresponding expense. But more importantly, blockchains require validators to process transactions.
Right, the nodes running the network.
If Circle runs its own validator nodes on the ARK network, they will get paid transaction fees and block rewards natively in ARK tokens. Because the cost basis of those newly minted rewards is 0, every single token they earn from securing their own network drops straight into other revenue as pure profit.
So when management tells Wall Street, our 2026 guidance is unchanged, what they're actually saying is, we are legally choosing not to model in the massive pure profit revenue stream that will hit our books the second ARK launches, because GAAP accounting makes it too complex to forward project.
The guidance is artificially suppressed.
It is a massive coiled spring sitting just completely off the balance sheet.
Exactly.
Let's look at another highly revealing margin mechanic from the Q&A, the RLDC margin. RLDC stands for revenue less distribution cost. This margin improved in Q1 to 41.4%. Now, for someone not deeply entrenched in stablecoin mechanics, what exactly is a distribution cost? Why is Circle paying money to distribute its own coin?
Well, in the early days of the stablecoin wars, it was a race to acquire market share. A stablecoin is only useful if it's liquid on major exchanges.
All right, you need places to trade it.
So Circle and competitors like Tether would go to massive crypto exchanges and essentially say, if you list our stablecoin, prioritize it in trading pairs, and hold billions of it on your platform, we will pay you a distribution fee.
And what did that fee look like?
Often, it took the form of sharing a percentage of the interest yield earned on the underlying fiat reserves.
So they were essentially paying rent for shelf space at the digital grocery store.
Exactly. It was a costly, highly incentivized customer acquisition strategy.
So in the Q&A, the CFO attributed the RLDC margin improvement to a, and I quote here, modest pullback in certain highly incentivized channels. I have to admit, reading the transcript, it was somewhat comical watching the Wall Street analysts try to corner management into saying the word Binance.
Oh, they've tried so hard.
They practically begged them to admit they had slashed the yield-sharing agreements with Binance to boost margins, but management dodged it expertly. They just kept saying, we evaluate our partners dynamically.
They played the political game perfectly. But the underlying business signal is undeniable. Circle is transitioning from a startup fighting for growth at all costs to a mature enterprise optimizing for profitability.
They have pricing power now.
Exactly. Circle's market position is now so dominant, and the organic, unincentivized B2B demand from companies like Stripe and Meta is so strong that Circle no longer has to pay extortionate rent to crypto exchanges to maintain their volume.
They can just turn off the tap.
They can turn off the faucet on those expensive distribution deals, and the savings flow immediately to the bottom line. That's what expanded the RLDC margin by 1.5 percentage points.
And this maturation of the business model is aligning perfectly with what looks like a massive regulatory tailwind coming out of Washington right now.
The Clarity Act.
Yes. The earnings call heavily referenced the Clarity Act, specifically Title IV. Now, just as a disclaimer to you listening, we are analyzing this purely through the lens of corporate finance. We're not taking a political side here. It doesn't matter if this legislation is championed by the left or the right. We are strictly evaluating how this potential law impacts the legal reality of Circle as an operating business.
And from an operational standpoint, regulatory ambiguity is the single largest headwind preventing global enterprise adoption.
How so?
Well, for the past 5 years, Fortune 500 treasurers have looked at stablecoins and said, the technology is objectively superior to SWIFT, but my general counsel won't approve integration because we don't know if the SEC is going to classify this as an unregistered security tomorrow.
They are paralyzed by the threat of retroactive enforcement.
The Clarity Act solves the paralysis. It explicitly provides a legal framework for traditional banks, broker-dealers, and trust companies to custody and transact in stablecoins. It basically takes stablecoins out of the regulatory gray area and codifies them into the formal banking system.
But there is a very specific nuance in Title III that Circle's president, Heath Tarbert, highlighted, and it deals with how the stablecoin generates value for the user. I was reading this section, and it essentially legally differentiates Circle's model from the crypto models regulators historically hate.
He is referring to the legal distinction between passive yield and transactional utility.
Break that down for us.
Regulators despise digital assets that promise passive yield. And that's where you buy a token, hold it in a wallet, and it automatically pays you 5% interest for doing absolutely nothing. That looks, walks, and quacks exactly like an unregistered security offering or a shadow banking deposit under the Howey test.
Right, because you are expecting a profit derived purely from the efforts of others.
Exactly. But Circle doesn't operate USDC like a savings account. USDC does not pay yield to the end user. Its value proposition is its velocity.
The speed we talked about earlier.
Right. It's the ability to settle payments instantly, remit money across borders, or facilitate those high-frequency AI microtransactions. The drafted language in the Clarity Act specifically protects and encourages business models based on this kind of transactional utility.
So if Ramp or Kiribati want to build a software tool that rewards users for using USDC to settle corporate invoices faster, the law actively protects that activity because it's actual economic utility, not just passive speculation.
Yes, the legislation essentially looks at the entire digital asset landscape, points directly at Circle's B2B utility model, and legally designates it as the safe standard.
Wow.
It provides the exact legal cover that risk-averse multinational corporations need to fully commit to migrating their treasuries to Circle's infrastructure.
We have covered a massive amount of ground here today. We've dissected the data, we've broken down the corporate treasury API flows, we've extrapolated the mechanics of AI nano payments, and we've unpacked the accounting alchemy of the ARK token launch.
It's a lot of process.
It is. This brings us to the bottom line, though. Evaluating all of these vectors, where do we stand on CRCL based on this Q1 call? Are we bullish or bearish?
The narrative is exceptionally compelling, but the valuation framework requires a complete paradigm shift.
My stance is undeniably bullish, but with a major caveat for retail investors holding this stock right now. If you are checking the price of Bitcoin every morning to figure out if your CRCL shares are going to have a good day, you are fundamentally misunderstanding the asset you own. The decoupling is real.
The crypto casino metrics are just no longer relevant here.
You have to model this company based on global cross-border payment flows. You have to monitor B2B treasury adoption rates on platforms like Kiribati. And above all, you have to track the transaction volume of the AI agent economy.
That 99.8% market share.
Exactly. They hold a 99.8% share of a machine-to-machine economy that is poised to grow exponentially over the next decade. They have decoupled from speculation and entrenched themselves as the foundational plumbing of the internet economy.
They're building the pipes. And eventually, every data center, every bank, and every AI agent will have to pay the plumber.
I want to leave you, our listener, with one final structural thought to consider, something outside the direct numbers of this call. We spent a lot of time discussing those nano payments, the millionth of a penny streaming off-chain for AI compute.
Yeah.
Project that reality 5 years into the future. We are moving toward a world where software programs will autonomously negotiate, purchase, and trade data, server space, and physical logistics thousands of times a second, entirely invisibly. Picture your smart refrigerator negotiating supply chain logistics directly with a grocery warehouse AI.
Or autonomous vehicles negotiating microtolls in real time to use a fast lane.
The hyper-financialization of background tasks. But if USDC is the default natively integrated currency of those machines, it fundamentally shifts the balance of power. If the entire autonomous digital ecosystem runs on Circle's infrastructure, who really controls the economy of the future? Is it the software engineers at Google or OpenAI who write the algorithms? Or is it the entity that mints the AI's money, manages the economic operating system, and controls the underlying ledger?
History suggests that whoever controls the money supply ultimately dictates the terms of the economy. It's a profound shift in leverage from the application layer down to the infrastructure layer.
And that is a reality Wall Street is just beginning to price in. Thank you for joining us on this deep dive. I encourage you to look closely at the infrastructure in your own portfolios. Are you holding the applications or are you holding the ledger? Until next time, keep digging past the headlines.